Good evening and welcome everyone. My name's Brittany Williams and I'm going to introduce you to Wesley Oliver in just one moment. He's going to be your presenter for this evening. We are just waiting for a few more people to get in on the call. And before we get started, I know that a lot of questions are going to come up during the presentation. We actually already have a question and the webinar hasn't even started. But everyone should have a box in their right-hand corner with a tab labeled questions that you can type and submit your questions to throughout the presentation. So there's a lot of people on the call today, so it's not likely that we're going to get to everyone's questions. However, if you ask the question and it does not get answered during our time together, Wesley will be able to answer it for you over the next 24 hours via email. So while we wait for everyone to join the webinar, I'm going to put up a poll on the screen. And if you guys would like to participate, we would really value your feedback. So here's the question coming up. Have you held off on seeking to purchase a home because of any of the following? And then you have a few options in front of you, and the responses will be kept confidential, so don't worry about it. I'm going to pull that right now. So you can select more than one option, have not been able to save for a down payment, have been working on my credit rating, have been waiting to buy again after hardship, and have not found a company to give me special attention needed. Lastly, have not found affordable homes in the area that I want to buy in. So I'll give everyone about a minute to respond, and then we will move on with Wes's presentation and get started. Okay, we have about 10 seconds left in the poll, so finish up with your answers, and then I will hand it over to Wes. Okay, I'm closing the poll. Officially closed. And Wesley, please take it away.
Good evening, and thank you all for joining me this evening. I'm sure you guys all had a long day of hard work, so I'll try to make this as brief as possible, yet while giving you guys the information you're looking for. So first and foremost, I'm a home finance specialist and a senior licensed loan officer with Broadview Mortgage. Many of you may not be familiar with our company simply because we don't typically advertise in traditional ways. One of the reasons being is because we deal specifically with the purchase market usually. So we have 26 years of purchase market experience. We are a direct lender, and that does mean that we can underwrite, process, fund, and service our own loans. We are also ranked in the top 100 lenders in America, which is sensational considering that we're licensed solely in California. And our goal as a company is to educate, create, and empower home buyers. So we do a lot of webinars and seminars and community outreach programs specifically for that purpose. And tonight I'm really excited to speak with you guys about down payment assistance and specifically about how purchasing a home in today's market can be done with limited savings. So before we go into that, I think it's important that we understand what the challenges are that homeowners are facing right now. That way we can really understand and speak to the benefit of these programs and how they're really there to help you. So first, let's take a look at the foundations of qualifying for a home. And I look at it as the three pillars. The first one being income. And income, basically, you make what you make, and we can qualify you for a loan based on that. Whether or not you're able to buy the type of property you're interested in with your income, that's a whole different story. But if you have income, that's a good thing. Secondly, your credit rating, and this is just an illustration of how you show up for your finances and your financial obligations. And then lastly, we have assets, which that really speaks to, what you're going to need to invest in the property. So just looking at those three items, let's take a look at what the real challenge is for most homeowners. Now, we know right now there's about a 56% homeownership rate in the state of California. So obviously there's plenty of room to improve and plenty of homeowners that are welcome to enter the market. The average income for a household in California is about $5,100 or slightly over that, which is pretty good income, especially compared to a lot of other states. The average credit score in California is 649 points. Again, that's really good considering some loan programs will qualify you with a credit score as low as 580 points. And the average savings amount for the average household is about $3,800, which I know some people don't have that. Some people might have more, and some people might actually think that that's pretty good. But when you look at the overall picture and what's needed to purchase a home, income, most people usually have it based on what we just looked at. Credit's typically not an issue. So the missing link happens to be the asset portion. And that's really what we're here to speak to this evening. Now, here's the real challenge and why it creates a problem. The median home price in California is about $372,000. The minimum down payment required would be about $13,000 or 3.5% of your purchase price. Now, there's the other side of that, which is also the closing costs that are involved with purchasing a home. It could be on the low side of 2%, could be as high as 4%, really just depending on seller contributions. So for this illustration, I took the middle number of 3%, so that would mean slightly over $11,000 in closing costs. So that gives us a grand total investment required of just over $24,000. So the question is, what are our options for coming up with those funds? Well, the first option for most people that they'd consider is gift funds. And if you have, wealthy parents or a rich, Uncle Ben or Aunt Betty, well, that's probably the best way to go. But if you're on this call tonight, I'm going to assume you're in the same boat as me and you don't have that option. So the next option most people usually consider are their 401k funds. And the 401k funds are your retirement. You can usually draw directly from your 401k, or you can take a loan out against your 401k. And the most consistent method that most people usually consider is just saving the money flat out. So those are primarily the three methods that you would take in order to come up with the funds to purchase that property. Now, we already ruled out the first option, so let's take a look at our two savings options as a solution. The average 401k balance for someone the age of 32 is about $77,000. Now you're looking at an investment of $24,000, so you would have to take out almost a third of what you've already saved for retirement in order to purchase that home. Now the scary part about that is with all the discussions about Social Security not being there by the time we retire, and most people really don't have enough saved to retire, that's probably not the way we want to go, especially when you consider the tax implications of, withdrawing from your 401k early. Now, just saving the funds on your own, as we discussed earlier, the average savings account balance right now is about $3,800, but the most important part is the average monthly savings contribution is only $150 per month. So let's say we set a plan together and we're going to save for the funds to purchase that home. Well, I have a couple scenarios to look at. Scenario number one As we know, we need just over $24,000. If you're the average American household, you're putting away $150 per month. And that means it's going to take you about 13 years in order to come up with the necessary investment to purchase your home. But let's take a look at scenario number two, same amount needed, but let's say you're very aggressive and you're able to put away $500 per month. Well, even if that's the case, it's still going to take you 4 years to accumulate the funds for the investment on that property. So here's really what's at stake if we're going to wait that long. We're going to take a look at the effective purchasing power. First and foremost, I think one of the biggest benefits of being a homeowner is what I like to call rent control. Now, we know that on average, your rent payment is going to go up 3% from year to year. But if you're in a 30-year fixed mortgage, your mortgage payment does not change over time. So if you look at the chart there, it's basically a comparison of the homeowner versus the renter. Now, the average rent payment in California right now is close to $1,400. The average mortgage payment is slightly over $1,500. So in a 5-year period, they're going to be pretty close to neck and neck. But as you see, year number 10, the homeowner saving close to $250 a month compared to the renter. Year 15, the homeowner saving close to $500 a month, and by year 20, the homeowner saving close to $750 a month. Now, the other side of that is basically purchasing power, and purchasing power is affected by interest rates. For every 1% rise in your interest rate on your mortgage, you're going to see a decrease of almost 11% in your purchasing power. So here's what that looks like. Let's say right now rates are about 4.5%. That's about the average. Your principal and interest payment would be about $2,280 a month on a $450,000 property. If the rate were to go up 1%, you would see your principal and interest payment increase to $2,555, and you would see an increase in your mortgage payment of $274 a month. And I like to look at this as a loss in your discretionary income, because that additional $274 could be going toward savings, could be going toward a vacation, could be going toward the provision of an education for a child. Now, if rates continue to go up, and we're now at 6.5%, that principal and interest payment becomes $2,844 a month. And now we see an increase of $564, or a loss of discretionary income of $564 a month. If rates go up yet again, another percentage point at 7.5%, we see a principal and interest payment of $3,146, and we see an increase in our payment of $866 a month. Now, there's the other side of that. What if you only qualify for a mortgage payment of $2,288 because of your income? Well, now that's when you're going to see the incredible shrinking house, and here's why. At 4.5%, you qualify for that $450,000 mortgage. At 5.5%, you now can only purchase a house at $403,000. At 6.5%, you can only purchase a property of $362,000. And at 7.5%, you can only purchase a property of $327,000. Now, the last 10 years of interest rates, back in 2004, the rate on average was about 5.8%. In 2012, it got as low as 3.6%, but now it's back up to 4.5%. So I think we've seen the bottom of the market, and it's as low as it's going to go, and now it's inching its way back up as our government stops printing money. So here's how it really affects you. I took a look at 2 properties in the same city, same neighborhood, or same general area, and I looked at 2 values for those properties. Property A has a purchase price of $450,000. It has 4 bedrooms, 2.5 bathrooms, 1,640 square feet of living space, and 6,098 square feet of lot space. Property B has a purchase price of $403,000. It's 2 bedrooms, 2 bathrooms, 1,175 square feet of living space, and a lot of 4,050 square feet. So here's the net loss. You've just lost 2 bedrooms, half a bathroom, 465 square feet of living space, as well as 2,048 square feet of lot space. And that's significant, especially as property values change. Obviously, the property that is in location A is going to appreciate faster than the property in location B. So what is the answer? What's really the solution to get into the property market now and avoid these pitfalls? And really what that comes down to is what we want to do is we want to have a straight line solution. The shortest distance between 2 points is a straight line. So down payment assistance is really a great way to help with that. So there are a few different organizations funded throughout the state of California that are there to help provide down payment assistance to individuals and families looking to get into the purchase market. The purpose of the program is to provide special financing to low to moderate income families so that they can achieve home ownership. Here's a few of the program highlights and basically what they can provide for you. First and foremost, assistance comes in 2 forms. The first form is what's known as a junior lien, and the second form is what's known as a grant. Any funds you receive through a grant program do not have to be repaid. If you receive a junior lien, what you have is another loan that goes along with your primary mortgage that has deferred payments. And the payments are deferred for the life of the primary mortgage. So if you have a 30-year mortgage and it takes you 30 years to pay off that mortgage, at the end of the 30-year term, that's when you'll start paying on that deferred loan. You'll receive a minimum of 3%. So every program out there will provide you at least 3%. But the best news is that a lot of the programs can be layered, and in a lot of cases you can end up with as much as 103% financing. How do we get that 103%? Well, the programs can be used for down payment assistance and or closing cost. So in our earlier example, you had to put down 3.5% for the purchase of a home. So if one program were to provide you with 3.5% for the down payment, if you were to layer that with another program that provided you with an additional 3% for closing cost, that's where you would get that 103% financing. Now, down payment assistance definitely is not for everyone, and everyone's not going to qualify for a down payment assistance program. But here are a few of the guidelines and what they're looking for to see if you do qualify. They do have minimum income limits. And so depending on the county you're purchasing in, the household income cannot exceed the income limits for that particular county. Now, the good news is, depending on what county you're purchasing in and the cost of living in that county, they do have more flexible and more lenient income limits. So obviously, if you're purchasing a home in Orange County, they're going to allow you to make more money than someone who's purchasing a home in San Bernardino County. Also, they do allow you to make more money if you have more people in the household. There are also loan limits or sales price limits. And again, those are based on the county you're purchasing in. So again, it costs a little more to purchase a house in Orange County than it would, say, in Riverside County. So they're going to be more flexible and allow you to purchase more in Orange County than, say, Riverside County. They have a minimum qualifying credit score. And the great news about that, they only require that you have a credit score of 640 points. And the interest rates in the program are set by the program administrator. So it doesn't matter how much higher your credit score is than 640 points. Everyone's going to get the same credit, the same interest rate. And that's really good because the interest rates in the program right now are very close to the market rates. They do have minimum qualifying debt ratios, and that's simply your debt to income ratio, or the measure of your gross monthly income compared to your monthly debt obligations. For all the programs, they do require that you are at 45% DTI, and that's something for us to figure out. That's nothing you want to spend too much time trying to figure out on your own, but definitely will qualify you based on that. Most of the programs are for first-time home buyers. Not all of them. There is a particular program that does not require that you're a first-time home buyer. If it does require that you're a first-time home buyer, the good news is their definition of a first-time home buyer is simply someone that has not held title to a principal residence in the last 3 years. So if the last time you owned a property was 4 years ago, congratulations, you're a first-time home buyer, and therefore you're qualified for all these programs. If you are using a first-time home buyer grant or junior lien, they do require that you complete a home buyer education course, and that is pretty simple. You can even complete it online, or you can go to a venue. And then lastly, they do require that you are approved you do work with an approved lender and an approved originator. So as you guys are probably aware, there are a lot of lenders in the state of California, but only a handful of them are actually approved lenders to provide these programs to the public. And thankfully, Broadview Mortgage is one of those approved lenders. Also, the programs are compatible with USDA, VA, FHA, and conventional loan programs, just depending on the program. So if you're a veteran or if you're purchasing in an area where it is a USDA approved area, then you also have the option to use these programs as well. Now, the programs are well funded, especially the state funded programs. One in particular program, which is the California Homebuyer Down Payment Assistance Program, every month they start with $5 million in available funds to fund the program. FCHAFA, which is a grant program, starts with $25 million available every month. The Extra Credit Teacher Program, which is specifically for teachers throughout California, starts with $5 million available every month. And Platinum, which is another grant program, starts every month with an available $25 million for grant funds. Now, we know the programs work, and we know that people are taking advantage of them. One particular case, the CHDAP, last year they had over 6,300 loans totaling $37.7 million. And NHF, which is one of the foundations that funds the grant program, they have over 60,000 applicants that have loans totaling over $8.6 billion. So we know they're working, and people are definitely taking advantage of them. So what is your next step from here to see if you have the ability to take advantage of them? Well, first and foremost, we start with a pre-qualification, and that's a simple 10-minute interview with myself, and there's a few specific questions that I need to ask you, and that'll kind of give me an idea of whether or not you qualify for one of these programs, and which types of programs and how many of them would be available to you. But of course, we don't want to just hang our hats on that, so the next step would be to go through a pre-approval. Now, the pre-approval is just a more detailed version of the pre-qualifying process. With the pre-approval process, now we're actually collecting the documentation to verify the information that we gather on the pre-qualifying. And we want to do that to make sure that based on the guidelines for these individual programs that you are going to qualify. The programs have their own ways of calculating income and things like that. So we want to make sure that we're very detailed and we don't leave anything to chance if we are going to pre-approve you for one of these programs. Once we complete the pre-approval process, the last step is simply mortgage planning. And number one, if you for some reason do not qualify for one of these programs, then the next step is to figure out what we need to do in order to help you get into a home using conventional methods. If you do qualify for one of the programs, we're going to figure out which programs you qualify for and which programs make sense based on what your financial goals are for purchasing a home. So the final step is mortgage planning and really just basically finding a way to fulfill the needs that you have for purchasing a home and getting you into a home as quickly as possible. So that's pretty much the long and the short of it. And I don't go into too much detail about the individual programs because they all work similarly. But if I were to do that, you'd walk away from here really confused with a lot of questions and no answers. So the best way to do that is to, let the professionals handle it. So I'm going to open the floor up to questions. And as you can see on the screen there, You have all my contact information, my direct office number, my direct cell phone number, and my email. And if for some reason we don't get to your question this evening, or you have a question after this evening, please don't hesitate to give me a call on either one of those numbers or email me. And I'm going to be emailing all the attendees of the webinar tomorrow just to follow up with you, get your input on the webinar, and see if you don't have any questions. So I'm just going to go ahead and open the floor up to questions right now, and Brittany's going to help me out with that.
Okay, thank you, Wes. And again, if there's any confusion about how to ask a question, it comes up on your right-hand side. There's a little questions tab, and all you do is type in your question and submit it there. So I'm going to go on with our first question. It says, are there better homebuyer assistance programs than the FHA government program?
Well, that all depends on what your goals are as far as purchasing a home. And if you're talking about, most of the programs are generated to work with an FHA product simply because it's a lower required down payment. So there are definitely programs that are offered through specific cities or specific counties that you can also look at. And like I said, that really depends on what your goals are. We tend to focus on the ones that are driven through the state of California simply because they're more consistent. They don't usually run out of funds, and we don't have to worry about the programs disappearing overnight.
Okay. Is Our next question is there a minimum or maximum income that you need to qualify for assistance?
There is an income limit that you cannot exceed depending on the county you're purchasing in and the program. So if you're looking at it from the program side of things, yes, there is a certain income that you cannot exceed. If you're looking at it from a qualification as far as what type of mortgage payment you would qualify for, well, there is a minimum on that side depending on, what your payment, what payment you're comfortable with, and what type of property you're trying to purchase, and in what price range.
Okay. Next question. Are there any special programs for teachers?
Absolutely. The extra credit teacher program, that is one of the programs that I covered here. Um, it has $5 million available, like I said, at the beginning of every month, and it's funds that can be used toward down payment and or closing cost, and it can be layered with other programs as well. And then we also work with a program here with Broadview by the name of Homes for Heroes, and that is really something we do. We partner with real estate agents in particular areas, and they come down on their fees to help teachers, firefighters, police department, first responders, and veterans, and we come down on our fees as well. So yes, we definitely have a lot of opportunity for teachers.
Okay. Thank you, Wes. And if using grants or layering, are you still obligated to have mortgage insurance?
Yes, anytime that you're purchasing without putting 20% down, unless you're using a VA program, you are going to have mortgage insurance. The mortgage insurance on a conventional loan is a lower rate than you would see with FHA, but it's definitely going to be there. One of the big changes as well last year with the FHA mortgage insurance is that the mortgage insurance on an FHA loan is now, it's for the life of the loan, whereas on a conventional, you can still request that they remove it once you have 20% equity in the property, and typically they remove it automatically once you have 22% equity available in the property.
Okay. So, good question. How many years do you have to be out of a bankruptcy to qualify for these down payment assistance programs?
Well, when it comes to that, the administrators of the program rely on the specific guidelines of the particular programs. So with an FHA, you're good after 3 years. With the VA loan, you're good after 2 years. And if you're dealing with the conventional, depending on whether it's bankruptcy, foreclosure, or short sale, it could be anywhere between 2 years to 7 years.
Okay. So, since there cannot be an exceeded annual income according to the county, what has been the smallest annual income that you've seen have that has been approved?
You're probably going to be looking at somewhere in the neighborhood of about $50,000, and that's for an individual purchasing in like a county, say like San Bernardino or Riverside County.
Okay. What is the interest rate if there's a junior lien?
Some of the junior lien programs actually have no interest whatsoever. There is one in particular that would be the California Homebuyer Down Payment Assistance, and that one currently has a rate of 3.25%, and that is simple interest. So it doesn't work like your credit card. Basically, if you had a $10,000 loan, you basically see the balance increase by about $325 a year.
When using a down payment assistance program, how much cash is required to get the house?
Um, are you speaking of, well, if you're speaking of how much cash out of pocket for you would it be, the way I always explain this to people is this. None of the funds that are provided to by the program are going to be provided until about a couple days before your loan is actually going to fund. So you are going to have to prepay for certain items when you start the process. For instance, when you put an offer on a house, it's customary to offer, at least 1% as a good faith deposit based on the purchase price or the sales price. So if you're purchasing a $200,000 home, then you're probably going to have at least $2,000 at that point. Then you're also going to have things like your appraisal, if you choose to do a home inspection, things like that, that you're going to pay for usually within the first week of opening escrow. So you're probably going to want to have access to, 1% of the purchase price plus probably another $1,000 initially. And then the way the programs work, after you close escrow, any monies that are left over, of course, are returned to you.
Okay, we have another good question. Do all properties qualify for down payment assistance, or are there limits to the types of properties that qualify?
Great question. So for most of the down payment assistance programs, they work solely with one unit property, so a single family residence, townhome or condo. There's one in particular that actually works with a 1 or 2 unit, so it could be a duplex. And then also the most important thing is that if you are going to purchase a condo, it is very important if you're using an FHA loan that the condominium association still has their FHA approval still in good standing.
Are any of these grants silent seconds? If not, do silent seconds still exist, and are they beneficial in working with other down payment assistance programs?
Well, a grant is a grant, so it's not a silent second, it's a grant, so those funds don't have to be repaid. If you are working with a program like CHDAP, which does happen to be a silent second, then yes, you will have to repay the funds, like I said, at the time you pay off the first mortgage. And they're still really beneficial, especially just looking at it from a standpoint of interest rates increasing, which they're continuing to do, and we know they're going to continue to do. Property values, if they continue to increase. Obviously, it's the sooner the better if you're ready for the obligation of purchasing a home. So these funds provide you with the opportunity to get into a home with little out of pocket right now. And like I said, a lot of the silent seconds actually don't have interest. So you're basically just paying back the funds that you would normally have to save with no interest at all.
Okay, and I just have a question for you, Wes, before we get into another question that some of our listeners had. Um, do realtors know about these down payment assistance programs? And if so, do they need to know if we want to use down payment assistance programs to purchase a home? And when I say we, I mean us as home buyers. Does the realtor need to know in that process?
I think a lot of the real estate agents out there do have kind of a general knowledge um, about these programs, which is to say that they know they're out there and they exist. I don't think they have a lot of specified knowledge in a lot of cases. as far as what these programs do and how they work. And it's important that your real estate agent knows what you're doing. Obviously, you don't want them to be in the dark, but there are a lot of misconceptions amongst realtors and lenders alike that it's going to take longer to, it's going to need a longer escrow process, or it's going to take longer to fund the loan, or there's just more hassle and more involved in the process. In a lot of cases, they're wrong, but you definitely want to share that with your real estate agent, like I said, just so they know what's going on and what's to be expected.
Okay. So, someone had a question. If I want to apply, what's the next step and what do I do?
Okay, so the next step would be for, like I said, for me to spend about 10 minutes on the phone with you and just go through a quick pre-qualification. At that time, just based on the information I collect, I can pretty much tell, if one of these programs will work for you. And then after that, I would get our homebuyer welcome packet out to you for completion. And that details the process and everything we need, all the documents we need to collect to do a full pre-approval. Once we complete the full pre-approval, then you are off to the races and you can contact your real estate agent and let them know you're ready to get in the market.
Okay. So, I noticed that you're saying pre qualify a lot. And before I got into this industry, I heard a lot of pre-qualify and pre-approval, and I didn't understand the difference until I got into this industry. So, for other people who may not know the difference, could you please speak to that and what's the importance of the difference between the two?
Okay. So a pre-qualification is basically me and you having a conversation and me asking all the questions I would need to ask you to get an idea of your overall financial situation. So I would probably ask you about your income, what kind of debt obligations you have, what your credit score is, things like that. And of course, you're going to give me the answers to those questions the best you know how. The pre approval is actually us verifying what the true situation is based on using lending and underwriting guidelines. Because even though if I speak to someone who says, they get 4 hours of overtime every week, after I verify that with their employer, it might only be 2 hours of overtime every week over the course of, the last year or so. So we have to really make sure that we're verifying all the information on your application and we know what we're working with. That way you don't get into the process of trying to purchase a home only to find out once you have an offer accepted and you're in the lending process, your loan falls out of escrow because of the fact that they were just going off of information that they collected initially.
Okay. And how long does the process take from the time someone gets pre-qualified to the time that they could actually purchase the house and get themselves in the house?
Well, the answer to that is a lot of that really just depends on the individual, because it's a matter of how long it's going to take for you to return the documents that we would need to take you to full pre-approval. Once we've collected all the documents, then it's only going to take anywhere between 24 to 72 hours for us to provide that pre-approval to you. And like I said, at that point, you contact your real estate agent and schedule an appointment to go visit houses as soon as you can.
Okay. Another one of our listeners had a specific question about their credit report. They said, "What if I have some errors on my credit report? Should I get them fixed first and then call you, or should I call you now?"
That's going to really depend on the types of errors you're speaking to. So if you have, general errors like they have a social mixed up or an incorrect name or something like that, those are usually remedied pretty easily. If you're talking about challenging, some type of information with the creditor or balance that's showing, you're definitely going to want to get that remedied as quickly as possible, and you're going to want to have that dispute closed before you start the process.
Okay. And someone is noticing your telephone number, noticing that you're in the 714 area code and wondering, do you do loans in your area or do you do loans throughout the entire state of California or do you do national loans? What territory do you work in?
I work throughout the state of California. Broadview is licensed in California. That's the only state we're licensed in. So I am always happy to help anyone throughout the state of California. I've helped a lot of individuals, in Northern California, and actually I have quite a few real estate agents I work with in Northern California as well. But anyone who needs the help, we're here and ready to help wherever you are in the state.
Okay. We have someone who says, I'm working with a lender already. Is it too late for me to try to get into one of these programs?
No, up until the point where you've actually funded a loan and you're in the house, you have the opportunity to, shop other lenders and see what other opportunities and programs are available that would actually work for you. So, unless you already have a loan and you're in the house, you can definitely give us a call, and we'd love the opportunity to help you.
Okay. Does it reflect poorly on my credit by using down payment assistance?
No, because as far as your credit's concerned, it's a mortgage loan. That's what's going to be there. So it's not going to reflect poorly. In a lot of cases, it's not going to show up any differently than, say, someone who, back in the day used to do an 80-20 loan where they had, their primary lender and then they had a second lender that provided the other 20% so they didn't have to pay PMI and they didn't have to come in with a down payment. So it's just another lender on your credit.
Okay, so I believe that this concludes our question and answer session for today. We just finished our last question. And Wes, thank you so much for doing this. And I know that you're an expert in this and you really do value helping people. So it's good to have this presentation. And thank you, everyone else, for joining us today. And Wes, do you have anything else to say?
The last thing I have to say is if you are considering, purchasing a home, like I said before, sooner rather than later. And I know in a lot of cases, I'm the financial version of a doctor, and a lot of people don't want to talk to me because they feel like they're going to get bad news. But it's not bad news if you assess where you are, and that way you can develop where you need to be, a plan to get to where you need to be, and that's where we come in. So if you're at all interested in purchasing a home, give me a call as soon as you can, and let's look under the hood and see where you're at and help you get into that home.
Okay. And just for everyone to know, this has been recorded today and we will be posting it on our website and we can send you a follow-up email with the recording of this webinar. So thank you everyone. And thank you again, Wes. I really appreciate it.
Thank you. It was a pleasure.
Okay.